Fitch in its latest report said that growth projections for the US in 2025 and 2026 remain at 1.6%, a sharp decline from 2.8% in 2024. The rating agency upgraded the global growth outlook, but it pointed out that there is a clear sign of slowdown in the US economy. Even though US GDP grew by about 3% in the second quarter of 2025, following a 0.5% drop in the first quarter, then why does the US economy shows the sign of slowdown? In this video, we're going to take a closer look at just how bad America's economic situation really is. The first major crack in the US economy is the weakening job market. For years, the US job market has been considered one of the strongest pillars of the economy. But now, it's showing signs of stress. The Bureau of Labor Statistics revealed in a preliminary revision that the economy actually created 911,000 fewer jobs in the 12 months from April 2024 to March 2025 than previously reported. Put simply, the economy created far fewer jobs than first estimated, about 76,000 fewer each month, and that's nearly 1 million jobs disappearing from the economy. The report came after a lackluster August jobs report which shows that the US economy generated just 22,000 jobs in August and also revised June's job growth down to a loss of 13,000 jobs. At the same time, the unemployment rate rose to 4.3%, adding to concerns that President Donald Trump's unpredictable economic policies, including massive and unpredictable taxes on imports, have created so much uncertainty that businesses are pulling back on hiring. Despite the Trump administration's claims that tariffs would strengthen American manufacturing, the latest economic data tell a different story. Manufacturing jobs have been shrinking ever since President Donald Trump announced new tariffs in April 2025. Since then, the sector has lost about 42,000 jobs, while job openings have dropped by 76,000 and actual hires by 18,000. The timing lines up directly with the administration's tariff policies, which are projected to cost American households around $2,400 each year. Despite promises that these policies would revive US manufacturing, the results so far have been the opposite. In August 2025 alone, manufacturing lost another 12,000 jobs, bringing the total decline since April to 42,000. The sector is now performing worse than it did in 2024. The second major challenge weighing on the US economy is rising prices. And this is where many Americans are feeling the pain directly. According to the latest data from the US Labor Department, consumer prices climbed 2.9% in the year through August, rising from 2.7% in July. This marks the fastest increase since January. The higher inflation in the United States is primarily caused by rising costs for cars, household items, and basic groceries. For most Americans, one of the biggest sources of stress today is as simple as the grocery bill. A new poll shows that 53% of US adults say the cost of groceries is a major source of stress in their lives, while another 33% say it is a minor stress. That means only a small fraction of the population feels unaffected by rising food costs. Experts' analysis shows that US tariffs could raise household grocery costs by anywhere from $2,600 to nearly $5,000 per year unless families change their shopping habits. One of the main reasons these costs are climbing is the recent tariff policies under Donald Trump. Since Trump's latest tariffs took effect in August, most goods entering the US face taxes of between 10% and 50%, depending on their origin. By imposing import taxes on goods from China, Mexico, and Canada, these tariffs have increased the price of many everyday items, from groceries to household products. According to Yale's Budget Lab report, Trump's recent tariffs are expected to push up food prices by about 2.6% in the short term, with even bigger jumps likely for items like fruits and vegetables. This is happening at a time when many Americans are already feeling negative about the economy. A weak jobs report showed problems in the labor market, and rising inflation is making worries even worse. Meanwhile, the US Central Bank has kept interest rates unchanged since last year as policymakers continued to monitor the impacts of import tariffs on consumer prices. A Reuters poll found that nearly all 107 economists surveyed expect the Federal Reserve to cut its benchmark interest rate by 25 basis points in September, with most also predicting another cut in the following quarter. Similarly, Fitch forecasts rate cuts in September and December 2025, with more likely in 2026 as the Fed tries to support growth. But cutting interest rates might not fix everything. If inflation stays high, people's real wages will stay under pressure. And if tariffs continue or even get worse, consumers may stay careful with their spending, which could keep economic growth weak. At a time when prices, especially for groceries, are rising and more families are feeling the impact of it, real wages are falling. Imagine getting a 3% pay raise at work, but prices in stores go up 5%. In reality, you're worse off than before, even though your paycheck looks a little bigger. That's exactly what millions of American households are experiencing right now. According to data from the U.S. Bureau of Labor Statistics, average hourly earnings increased by 21.8% from January 2021 to July 2025. Meanwhile, the Consumer Price Index rose 22.7% over the same period, leaving real wages down 0.7% cumulatively. Higher inflation is reducing real wage growth, and this is one of the main reasons people are spending less. This squeeze on purchasing power is putting additional pressure on the overall economy. So, what does all this mean for the United States? The global economy may be improving slightly, according to Fitch. But in the United States, the weaknesses are becoming more visible due to a weaker job market, shrinking manufacturing, rising prices, falling real wages, and trade policies. These together explain why Fitch, and many other analysts, believe the U.S. economy is slowing down. What do you think? Are these signs pointing to a temporary slowdown, or something more serious for the U.S. economy?